So let's get into the max funded IULs. So it's not just an IUL because you can design these any number of ways, some much better than others. Uh, but we're going to look at max funded IULs. The whole purpose of this, again, is to accumulate the cash value and let it percolate and grow, and then take it upon retirement to supplement Social Security or pension or whatever you may have. What an IUL is versus what it is not. Okay, so it is designed to be permanent coverage. It When you look at an illustration, anybody out there who's seen them, some of them go out farther than others. Some of them you can run them out forever. Some of them, different lengths of time. However, it is defined as and meant to be permanent insurance, and there's always a guaranteed column in these. You have to show somebody the worst case scenario. That is, if the market tanks every single year and the carrier charges the most for the life insurance possible allowed every single year, and the client doesn't do anything about it every single year, it'll still be in force up until usually age 85 at least. But something like that, you can run them out and make them permanent. Cash value growth is built into these. That's the point. It's tied to an index or a number of indexes. Think of it like your 401k. You had choices each year to move your money 25% here, 50% there, whatever you want to do. You can do the same thing with this, but it's not actually invested in the market. I'll go over that too. Also, IULs as a life insurance policy usually, almost always, offer living benefits. Almost always you're going to have a chronic illness rider and a terminal illness rider included. Prudential has their BAR, Corebridge has their QOL product, which are like a suite of living benefits. So if the person runs into bad health or some situation like that during their life before they get into retirement, they can draw on this policy to help them out in a financial crunch. Um, and it's a great retirement supplement. Uh, Definitely, if you do this right, it's a great way to supplement again your pension or whatever you may have working, your investments and your savings. Um, an IUL is not an investment, and I did touch on that briefly. But you're not even supposed to say investment when you're presenting these. Most of you don't have a securities license. If you do, fine, that's a different thing altogether. Because even though this is tied to the performance of an index, it is not actually put into and invested in that index. So it's just kind of mirroring the performance up to a point and down to a point as that index performs throughout the year. Usually we're going to talk about a 1 year point to point, but it's not actually invested in there. That's why it's not at risk. So good thing to remind yourself, don't call it investment. It's not, and that means it's not nearly as risky. It's also not meant to replace other aspects of someone's portfolio. If they've got a 401k or other investments and savings you might want to replace, but depends on what it's doing. It's not there to take away from something else unless it's performing poorly and this is going to perform better or be less risky and things like that. So it's appropriate sometimes. Again, you got to talk to your client and find out what their situation is. Don't be shy to defer to their financial advisor. If they've got a portfolio and they've got savings and investments, they've probably got a financial advisor who's been following it for a long time, and you can defer to their best advice and even work with them maybe to see if it's a good idea to maybe move some of this into the IUL. This is not some hot new trendy product. All right, it's not the end all be all. Hey, this is the hot thing that everybody wants to do. They've been around since the 80s, um, or at least ULs, Universal Life, have been around since the 70s, 80s, and IULs specifically have been around since the 90s, so decades. And so we've got a lot of history here to work with and know what's going on. Again, that mitigates some risk. Past performance is no guarantee of future performance, but at least you get an idea. You can look back 20 years and see what's going on. And there are two main types of IULs. There are those that are primarily for the death benefit. Okay, we're not talking about those. You can do that. There are other products out there that may be more appropriate, may work better for that kind of a thing. It depends, but it's an option as something for just the death benefit. Fine. But what we're talking about is a maximum cash value IUL. It's a minimum death benefit. Oftentimes they can go down to 100,000 or less. And you do the maximum cash accumulation by overfunding it or max funding it to the best you can do without creating a MEC, which is a modified endowment contract, which just basically keep in mind that that gets the IRS all over you and gets them concerned. They suddenly say a red flag, this person's putting away too much money on a tax deferred or a tax free basis. So suddenly they're interested in what you're doing. So you don't want to do that, but there's a lot of flexibility there. There's a lot of uh, uh, ability to put plenty of money in and not be taxed on it without triggering that MAC. And it's usually an increasing death benefit. So even if you start at the minimum, say you just start at 100,000, it will go up, and we'll look at illustrations that show that, but it'll keep increasing to where it goes all the way to your retirement age, and then you can stop paying on it and then start drawing on it. And we'll talk about what happens there. Yeah, it reduces at that point, but it works out very well, and it outpaces that MEC trigger, the modified endowment trigger. So if there's a certain amount, it keeps increasing, which allows you to put more money in, which kind of outruns that issue. The good, the bad, and the ugly. Good things about an IUL and who it would be good for. Is it's a permanent death benefit, like we talked about. It's leaving a legacy for their family because it's got the death benefit to it, just in case you don't live until 100 or whatever you plan on doing in retirement. It's good for people up to the age of 55 for the maximum cash value. It's actually in particular situations, it can be for people older than that, even 60 years old, but then you're probably talking to somebody of significant means and assets that are able to fund it up front within say 5 to 7 years, but that's a whole different story. When you run into those, fantastic, bring them to me. I'd be happy to talk to you about how that works. And mid to high income clients looking for tax-free retirement. And I put in here this 10 times rule. 10 times rule is pretty simple. It's based on their age. If they can safely and comfortably put aside 10 times their age per month, say if they're 40, okay, $400 a month, this will probably work very well for them. Diverse portfolios, people, like I said, with 401k and other investments, it's a good thing for them. It's just another facet of their retirement plan. It is bad for get rich quick people. I think I mentioned the guys out there doing webinars, and they're selling webinars and say, yes, you can get money immediately. You can just get this policy and you can take out money right away. Just put in a little and suddenly it's got cash value that you can grab, and you don't have to qualify for a small business loan. Nah, don't be that guy. That doesn't usually work anyway. Okay, the basic elements of an IUL. Um, Essentially, it's like a teeter-totter, or like I say, like a circus balloon. If you squeeze one side, it gets bigger on the other side. You squeeze the other, it goes the other way. It goes up and down depending on what you're doing. If you do a higher death benefit, it's going to lower your cash value accumulation and potential because of the higher fees for the higher death benefit. If you do a lower death benefit, like we like to do, it becomes a higher cash value, lower fees, and more potential for the accumulation. The non-guaranteed cash value is usually illustrated at around between 6 to 8%. I'll show you some illustrations here momentarily and show you that piece of it. Popular indexing strategies such as the S&P 500. Not only is it popular, it's probably the most common one, and it's a really good one to present and to illustrate. Well, because it's performed well, it's performed for a long time, it's been around a long time. People know what it is, they're familiar. So keep it simple, you know. Here's what this does. Everybody knows what it is. Again, it's not some uh, Johnny come lately great thing that's going to blow up and you're going to be rich. No, it's steady and it's been good for a long time. The cap, which is the most it's going to do on your policy, is usually between 10 to 12%. So there's a cap on these things, and there's a floor. So the cap is usually around 10 to 12. Right now, the one that I ran is 11 and a half, I believe. And then the floor is zero. Again, zero is your hero. I'm sure you've all heard it. Um, that means if the market tanks like everybody knows it did in 2008, um, and it loses 30, 40%, you don't. Your money isn't literally in the index. It's not going to take that ride down to the negative 30%. It stops at zero. Um, Conversely, if it goes up 25%, okay, so it stops at the cap, 11 and a half, 12%, whatever that is, but it mitigates risk.